If you bought Google stock last year and held it for 12 months, you made about 66%. If instead you bought the right LEAP call option, you made almost 300%.
Same stock, same year, very different result.
So the obvious question is, why would anyone buy the stock? We will show you our take on the topic, our backtest results, and how to find great long-term calls to buy on Option Samurai. Before you think this is about gambling with options, let's be clear. Buying any random long-term call won't give you good results in the long term. Leverage works both ways, and sometimes it hurts badly. But when stocks are in a bull market, owning shares may be an inefficient use of capital, and this is where long-term options come in. When you buy 100 shares, you're committing the full amount of capital to a single directional trade. And that can make a lot of sense, especially if the company pays a solid dividend or you're building a long-term core position. But not all companies pay dividends, and in a strong bull market where the main goal is price increase, the challenge often isn't direction, it's capital efficiency. You're using a large amount of capital for linear returns, which can limit diversification and flexibility. This is where the trade-off becomes clear. And in a few minutes, we'll show you 3 detailed real-life cases comparing the stock and the option return. And when we ran this across a real group of stocks, the average yearly return with LEAP calls was significantly higher than simply owning the shares. We'll show you the exact numbers later in the video. But first, let's be clear. Long-term calls, also called long-term equity anticipation calls or LEAP calls, create leverage in 2 ways: delta and time. Because these options are long-dated, theta decay is much slower than with short-term options. You're not fighting the clock every day. And when the stock trends higher, delta increases, amplifying gains. This is why LEAP calls can behave more like stock, with leverage built in, all without the short-term time pressure most people associate with derivative contracts. To see if this actually works, we ran a full backtest. We wanted to create a data-oriented study to test these ideas and understand how this strategy actually behaves. And spoiler alert, not every stock that went up led to a profit with options. In our backtest, we started by identifying a group of stocks that reputable analysts had marked as buys or strong buys. These stocks form a reasonable starting point for a long-only portfolio. For each stock, we compared 2 approaches. The first approach is simple, buying 100 shares. The second approach uses long-term call options. For the options, we selected calls that were at least 10% in the money and set to expire 1 year later. These are the same types of LEAP calls you can find using our option screener, as we will show you in a minute. We ran this comparison across dozens of stocks. The full results and methodology are available on our blog. This strategy always leads to one of 3 outcomes. Let's look at one real example of each. The first scenario we want to show you is Google, which is the ideal case you'd always like to find. The stock was up about 66% in the 12 months we observed, which is remarkably good. And with such a good underlying move, the LEAP call was up over 280%. You didn't need perfect timing, you just needed a strong trend. And imagine this, if you only put a fraction of your capital on this option, you would have money available to buy even more long-term calls on different underlyings, creating a good differentiation in your portfolio. You won't always find good cases such as Google, but you don't need to find that many to make this strategy worth your money. Let's move on to the second case. Sometimes the underlying stock may move up, but your option may lose money. This is where most people get confused. Amazon had a wild year, but was up only by 3% at the end of the observed period. The LEAP call lost over 36%. The stock went up, just not enough. This is the silent risk of options. Small gains can still mean losses. You did not lose all your money because your 10% in the money option was still in the money, but it lost some value. Last, let's look at the worst case. Last year, PayPal dropped over 30%. The LEAP call lost essentially all its value because it went from being in the money to out of the money. This is the built-in stop loss of options. You can't lose more than what you paid, but you can lose all of it once the option falls out of the money. Now let's zoom out and look at what all 3 cases tell us together. You can see that Google is obviously the ideal case, with a large positive change in the underlying price, which leads your leverage to pay off. Amazon was a disappointing case since time value hurt your position. And obviously, PayPal is the nightmare scenario, but sometimes you will face it. And this is why having some portfolio diversification is a good idea. Now, if you had built a hypothetical portfolio with just these three tickers, Google, Amazon, and PayPal, here's what the numbers would look like. The average percentage return with LEAP calls was 48% versus 12% for stocks. But here's the important nuance. The dollar profit was actually lower, around $7,000 for options versus $10,000 for shares. That's simply because you're deploying far less capital per position. This doesn't mean LEAP calls are bad. It simply means that, like in every trading setting, you need a method. You don't randomly buy long-term options or follow a self-defined financial guru that tells you what to do. You take the matter into your own hands and start with stocks you already believe in. At Option Samurai, we built scans that do exactly this. First, go to the predefined scans page. Then click the LEAPS tag. You'll see several helpful scans for long-term options. For instance, let's select LEAP calls with high return on analysts' target price. This scan finds long-dated call options on fundamentally strong stocks and sorts them by the highest potential return if the stock reaches analysts' target price. It's a simple concept. We combine our stock scoring with analyst expectations, and then rank the long calls from the highest potential profit going down. And you'll often find setups with potential returns above 100%, which can be very hard to achieve with simple stock ownership. So here's the bottom line from our backtest. On a group of stocks that analysts had labeled as buys, LEAP calls returned 34% on average versus 18% for stocks. In percentage terms, options won clearly. In dollar terms, stocks came out ahead, $113,000 versus $336,000. But that's because stocks required way more capital to deploy. Another thing we want you to know is that we published the full research behind this analysis. All the data you saw in this video comes from that research. Scan this QR code with your phone if you wish to go directly to our full analysis. And we also provide a free Google Colab file so you can rerun the same backtest yourself over several years. You can plug in your own stocks. Choose your own years. And see whether LEAP calls would have made sense for your portfolio. And by the way, this is a backtest we keep updated year after year, so you'll be able to run in the future as well. LEAP calls aren't a shortcut. They don't replace owning stocks in every market. But when conditions are right, they can give you similar directional exposure, more flexibility, and better capital efficiency, as long as you respect the risk. If there's a strategy you want us to break down next, simple, advanced, or somewhere in between, drop it in the comments. We read them all, and the best ideas become the next video. Option Samurai scans millions of option combinations in seconds, so you can focus only on setups that match your thesis. Start your 14-day free trial. Find your edge with Option Samurai. And if you want to keep learning, click here for the next video.